Howdy, Jacob here. Hope everyone has a good holiday weekend and has a nice time off from work. Today I'll be doing an in-depth review on Gray Television, ticker symbol GTN. I think as for the other in-depth videos, this one might be a little bit shorter, but let me remind everybody about the company itself. So $815 million market cap with a nearly $7 billion enterprise value. So market cap to enterprise value is roughly over 8 times the market cap. So that's not something you want to see. It's in the media industry. And to me, when I see media industry, I get a couple of ideas. I see a lot of intangible assets, which we'll see on their balance sheet, which we see is very massive. And what I've historically seen for most media companies is a lot of debt. We see exactly that here. So 833 million in 2012 with 6.4 billion in 2022 long-term debt. And if we look at cash on hand, their cash on hand is $61 million 2022. There's just not a lot of cash there for the amount of debt they have, and they are producing cash flow very consistently. But they are, it looks like, to grow, they are making a lot of acquisitions, and to fund these acquisitions are going into debt to do it. And so there has to be a time before Judgment Day where the lenders come and say they want their money back, where you need to start focusing on the debt. And so for me, right now, 3.75% dividend yield. They pay out 81 million. They make way more than 81 million free cash flow, so they can easily afford this dividend. But there needs to be a time where you focus on buying down debt before the lenders come. And so I only wrote a couple notes here. So it is less than $1 billion company. And so for companies less than $1 billion, I really like to see a lot of insider ownership. And here I see only 5.3% on the insider ownership. You can see 5.3% held by insiders. And then again, I noted this, but this is just more recent. This is the most recent 23 Q3 report balance sheet. They have 21 million cash on hand and 6.2 billion in long-term debt. I mean, if I saw that, I would be thinking a safe company with these numbers would need to be producing 2 billion a year in free cash flow, or else it's just not, I'm just not comfortable with it. And this company is absolutely not producing $2 billion in free cash flow. Looks like they're averaging a 5-year average of, let's say, 300 million. And that's with no cash on hand. If I were the lender, I would say Ictionary on the dictionary. No way. Um, they have a recent net loss, and that's due to an increase of expenses, roughly in line with inflation. But their revenues are down a lot due to their political revenue being down 80% and making up last year of roughly 10% of revenue, leading to a 7% decline in revenue due to the other revenue sources being relatively flat. And so there's three main sources of revenue here on the advertisement side. And as for political revenue, it got absolutely slashed. And yeah, last year it only made up 10% of revenue, but this year it's making up nearly nothing. And so it almost dropped the 10% of the revenue that it made up, which we can see through the 7% decline in revenue. So the other two are relatively flat, which is, as expected, I guess, for a media company. But um, a huge decline in political revenue again makes sense. 2023 didn't really have a lot of advertisers on that front, but 2024 we'd probably expect massive influx. So it's just a very seasonal event based on the year, but just something to note. That's why there's a big net loss here and the most recent quarter. So here's just talking about the debt again. So interest expense of 22 through Q3 was just under 10% of revenue. So if you take interest expense divided by total revenue, it's about 10%. And the interest expense for 2023 Q3 we're looking at just under 14% of revenue. So interest expense jumped 28% year over year. It's a massive increase, and that's partly due to increase in interest rates as well as their debt going up. And what a company like this needs to see is that they're going to have to start focusing on buying down that debt if they want to start producing positive free cash flow and be comfortable that their lenders will lend to them again. And so the last note I have here before getting to my assumptions is at this moment, the debt is very alarming, and I want to see action to minimize this. I think that they can afford this dividend. I've already said it. I think the payout is well under 25%. Let's see, 80 million. They produce probably 320 on average. So let's say 25, 30% payout. I think that's fine, but I think the other 70% needs to be paying down debt. Or if this were really something that, you didn't expect lenders to be able to lend to you again unless you got it under a certain level, I would just cut the dividend and use every ounce of free cash flow I had to pay down this debt. I don't care about growth. I don't care. I care about surviving at this point. And if you become insolvent, then you're just going to have to sell off everything you have for likely pennies on the dollar, which is the definitely not attractive thing to see. And so let's get to my assumptions now. So 0% on the revenue growth. After seeing the revenues for the two of the three sources relatively flat and the one heavy decline, I think I'm fine with no growth. We're saying, sometimes it'll grow, others it won't, but the three businesses in whole will be relatively nothing. And um, based on historical numbers, we can see that their price to earnings has been very low, well below average, likely due to how much debt they have. So the P and price to free cash flow are based on market cap, but it looks like this is so low because, again, their debt is so high. So their price to enterprise value is likely much greater, probably looking more like the 13 that you're looking at, given that their enterprise value is, 7, 8, 9 times market cap. But because of that, I lowered the P and price to free cash flow, and then there's so much debt that I need excess return. So this is saying 34% drop before a 17.5% return, given the assumptions. But again, not everything is about numbers. Not everything's about a story. Everything is about combining the two and making it comfortable for you. If you're not comfortable with the amount of debt that this company has, and you're not confident that a lender is going to stick with it, then don't buy it. I mean, it's as simple as that. There's so many companies out there that there's no reason to fall hoax to something that, there's thousands of other businesses out there that may be more comfortable for you. And so do your own analysis, get your own numbers, but remember that not everything is just about numbers. You have to bring in the balance sheet, which this analysis does not necessarily do. So you have to tangibly think, how is the balance sheet affected with these figures that I'm showing? And to me, I want to see a company that realizes that they can't just go into debt every single time they want to grow. It has to be thought of as at this point, literally a last resort because of how in debt they are in relation to the earnings that they have and the cash that they have on hand. I hope everyone learned something out of this video and has a good time reviewing it. And I hope everyone has a fantastic day and fantastic time into the weekend ahead, where hopefully you have some time off and some time with family. Thank you. Have a good one.